This will be disastrous and crash the economy. I'm your host, Steven Van Metre, and thanks for joining me today. And we're on the eve of the Federal Reserve making one of the biggest policy mistakes in modern central banking history. And you're about to find out just how big a mistake they're about to make. Let's head over to Bloomberg, who headlines today with the U.S. Producer Price Index rising 10%. Now, this is prices coming out of the factory rising 10%, reinforcing the Fed's rate hike path. The PPI increases 0.8%, which is huge from the month earlier after a 1.2% increase in January, with most of the prices due to higher food and energy. The data reflects the biggest monthly gain in the price of goods and dated back to 2009, which should be an indicator because we all remember what happened in 2009. That's right, we had the great financial crisis with 2/3 of the increase due to energy. Food prices were also up. It's the latest indication of rapid inflation in the U.S., and prices are poised to accelerate further after Russia's invasion of Ukraine sent prices for some raw materials to new heights. And the Fed will have the latest inflation data in hand for its meeting that concludes tomorrow, when policymakers are widely expected to increase interest rates for the first time since 2018. Among the decision, the Fed will release updated forecasts for inflation and growth. And no doubt, the Fed will have some rosy expectations. But just how big of a mistake they're making? Well, let's dig into the details here, because here's a graph of the Producer Price Index against the federal funds rate. And I want to point out why there was not really a strong relationship between these. You'll notice me back in the 70s and 80s, there was a reasonable relationship. But as we move into more modern history, there wasn't one. But I want you to note that after the great financial crisis, there's absolutely no relationship between producer prices and the federal funds rate. And you can see it because the red line's right over the black line. In fact, excluding volatile food and energy components, the so-called core PPI increased a mere 0.2%. Now, this is good because if you're looking for news that's disinflationary, well, we're starting to see some from a month earlier and was up by a whopping 8.4% from a year ago, both missing estimates. There were signs in other parts of the economy that inflationary pressures were cooling, and prices for final demand services were little changed from January, the first month without an increase from December 2020. Now, does that even matter? Does the core PPI matter? Does excluding food and energy matter? And the answer is not really, because we didn't see in the great financial crisis producer prices come down before the core did. So right now we're seeing what looks like a peak in producer price index. The core is not giving us a signal, but it's giving us some indicator that perhaps things, well, aren't going to be as bad. But what really matters isn't what comes out of the factory, it's what you and I actually experience when we go to the store. And so now let's take a look at the consumer price index to see, again, massive policy mistake by the Fed. Because up until the 80s, you'll notice that there was a fairly strong relationship between the federal funds rate and consumer prices. When the Fed raised rates, consumer prices were either just starting to rise or had already or we're just about to head higher. And what happened as we get into the 80s, and unfortunately I used to have this wonderful article written by the Fed, and I've misplaced it, and I've been looking for it, and I can't find it. Anyways, it says that the relationship between inflation expectations and the federal funds rate went away in the 80s. Now look what happens now with consumer prices. What you'll see in going into the 90s is inflation is flattening out, which is fine, and then the Fed plays catch up. And then in 2000, we get into the early 2000s, and consumer prices are rising, and the Fed's cutting rates and then decides to play catch up. And then you'll see here, again, in the great financial crisis, this is where everything changes, because regardless of what inflation is, for the most part, the Fed's doing nothing. But what's key is in the past, and we look at mistakes, notice where the Fed starts hiking. It's when consumer prices on a year-over-year rate of change are at a relatively low point in the cycle. And that's what you want to do. You want to be hiking as price pressure is building, not after it's already up. And this has caused some people to go bonkers over the Treasury market as yields rebound to new multi-year highs, according to Wall Street Journal, as yield on 10-year Treasury note hit the highest close since 2019. And of course, people seem to think that there's a huge relationship between consumer prices and what the Fed's doing. Well, there's not. While some have thought that higher commodity prices could slow economic growth. Now remember, what is the key thing for interest rates is economic growth and inflation expectations. So when growth is slowing, yields tend to head lower and therefore make the Fed cautious about raising interest rates. Quote, our view is that for the U.S., that the inflation impact will be higher than any negative impacts from growth. And that is what is driving right now the bond market, is this inflation expectations. But do people have it right? Are all the people that are dumping bonds, money managers, investors, and speculators who are shorting bonds, do they have it right? The answer is they don't, and neither does the Fed. And I want you to see this. Is now when we look at the 10-year Treasury yield and the federal funds rate, well, again, we'll notice up until the 80s, when the Fed admittedly, after the 80s, it wrote a paper and agreed that, hey, there's a disconnect here, that the Fed no longer has control of the long end of the curve. You'll notice prior to that, there was a reasonable relationship between the two. And things start to break down as we get into the 90s. And notice now, in coming out of the first hike cycle in around 2004, notice how 10-year Treasury yields pretty much ignore it. They just go flat. And how about in 2015? And we see as we get into that rate hike, yields go down, because there's one thing that people get wrong about Treasury yields every time. They think, oh, it has something to do with the Fed buying bonds. Not so much. You think it has something to do with the Fed selling bonds. No. The banks buying them. No. How about foreign investors buying them? No. How about, where the sun is shining today? No. There's really one thing that matters more than anything. And the one thing that everyone overlooks, and it's demand. And that's what we have to understand, is why does the Fed get this wrong? Why do rates collapse when inflation gets too high? It's not because yields follow inflation higher. It's because as prices go up, not only can people not afford those higher prices, they don't want to borrow at higher prices. So when rates go up, as people unload bonds on the secondary market and speculators short them and drive rates up, thinking that rates have to go higher, there needs to be demand. And if you'll notice throughout history, we can go back and look at this chart, you'll notice that yields continue to go down over time. And why is that? It's simple. There isn't demand at these higher rates. In fact, if you're wondering about what this means, there's one strategy that understands this when you have a recession. It was designed around this concept, and that's Portfolio Shield. I'll put a link in the corner and the description below, because if you've ever wondered why it does so well in recessions, it's because yields collapse. And why does that happen? It's a demand issue. And now that you understand that, well, let's take a look at the next slide, because the next mistake the Fed's making is you see in the yield curve. And this is the 7/10s. And so it's taking the 10-year yield, subtracting the 7, and they're inverted. They've been inverted for the last couple of days. And after inversions, the yield curve rises. Now, what does that mean? Does that mean rates are going to rise? No, that means they fall. And so what you tend to see is the front end, the shorter rate, the 7, will fall faster than the 10s. That's what happens when you see that blue line go up. And again, it's happening, now that you understand this a little better, not because the Fed stopped buying, not because the banks are buying, not because foreign investors are buying, because demand goes away. And this is really key. And notice now, from the federal funds rate perspective, when would you expect the Fed to hike? Well, when the yield curve is in a positive dynamic, when 10-year yields are much higher than 7s. And you see that throughout history. And now they're going to tighten into what's going to be a huge mistake, because what happens after the yield curve inverts and goes higher? You get a recession. Now, all right, let's keep going on, because how about from a volatility perspective? How about from an equity market? You wonder why when rates go up, stock prices tend to go down? Because higher rates are cutting into growth. And there is a point where they're going up together, and then all of a sudden rates are too high, cuts into growth, stock prices go down. But what about from a volatility standpoint? Well, we've seen now more modern history that rate hikes tend to signal an increase in volatility. But when has the Fed raised rates in the past? When volatility is generally fairly low in its cycle. And here I've circled some data points. Now it's way up here. The Fed's going to embark on a highest tightening cycle since they started tracking the VIX in the Fed database. And following February's plunge to new COVID lows, because this is going to get worse, the March's preliminary University of Michigan sentiment data was expected to fall even further, plummeting new lows not seen since 2011. Again, now think of this from consumer demand. I want you to understand this, because this is also very important of how the Fed's making another mistake without looking at the data. However, things were much worse than expected, with the headline sentiment print dropping from 62.8 to 59.7. as expectations plunged and current conditions slipped. Well, check this out. We're back to 2011 levels. And what did we have then? Do you remember? A double dip recession was in the cards. I mean, we're now just looking at data. Let's go back. We're just at the same levels back in the great financial crisis. And why does this matter? And I want you to understand, why do you see this being a problem? Well, what happens when why do interest rates go down when consumer confidence falls? And we've looked at this chart before. We'll look at it, I'm sure, here in the near future again. Why does this happen? Because what do consumers do when they're feeling good? They buy homes, they buy cars, and they buy durable goods, washers, dryers, fridges, things like that. And how do they pay for them? Most of the time, not with cash, with financing. And so when consumer confidence falls, what happens to interest rates? They go down, and it makes perfect sense. And now I want you to see what the Fed's going to do, because what the Fed is trying to do here is pull back on demand. And look at back in history now, when the Michigan Consumer Confidence Survey is high, that's when the Fed normally would want to hike, and it's when it makes sense because consumers can handle it. But now, and again, this is not showing the preliminary data, you have confidence at ultra low levels, and the Fed's going to yank demand out from under the consumer. In fact, look at this from the federal funds rate on inflation expectations. Usually when the Fed hikes, consumers aren't really concerned about inflation. They are now. And that in lies the whole issue here, is because the mistake the Fed's about to make is we're going to trigger recession. That's why interest rates are going to head lower. If you've wondered about this, it's a demand issue. And the only people that have demand for bonds right now are people trying to sell them and short them because they think rates have to go higher. But they haven't figured out that if no one's there to borrow, and that's why rates always plunge and head lower during recessions, and the Fed's about to trigger one. And if you wonder how low rates might go, well, just think, when no one wants to borrow, they're probably going to go near zero. And with that, I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video is provides educational information only, not intended to provide investment advice. You're not to be construed as recognition or solicitation by some security financial instrument or participate in any particular trading strategy. It's was prepared by Steve Van Metre. Personal capacity, opinions expressed in this video that do not affect the value of Inc. or Steven Van Metre Financial.